And globally, China reopening and the kind of impact that it would have both on China, how fast they can reopen, how well they can progress economically, and what happens with other emerging markets. Rana Gupta, Senior Portfolio Manager, India Equity Specialist at Manulife Investment, joins us now. Rana, good morning. Happy New Year to you, and thanks for joining in. Most equity strategists believe that now that China is going to reopen or has reopened, a lot of money could perhaps move into China versus other markets like India. Is that your thought as well, or do you think it could take some time for China to stabilize? And what is the preference now for 2023?
Okay, good morning, and happy New Year to all your viewers. We do think that China opening up will mean that some of the monies that will get allocated to China, but consider a scenario where China did not open up, and US is raising interest rates, and real rates are turning positive in US. That would have been, I think, financial conditions would have tightened much more. China opening up kind of offsets that. So in 2023, perhaps we will have a better emerging market growth outlook than the developed world. And that itself will mean that capital allocated towards the emerging markets can be higher. Yes, some of it will go to China over India. But we do think that overall the environment for the emerging markets looks pretty good with the China reopening that's coming through.
Okay. Good morning, Rana. Good to have you with us, and hope 2023 is a fabulous one for you.
Thank you.
But I want to ask you about India. At an index level last year at 4%, we may have outperformed. But for an Indian investor, that was not much, and certainly not if he was invested in mid caps and small caps. What might 23 hold?
Sure. I think if you look at the market overall return 4 or 5%, that's of course I think not enough for, let's say, an Indian investor who has a much higher risk, expectation. But I think Lata, we need to look a little deeper the sector indexes. If you exclude IT, which I think was down 25%, and pharma, which I think was around 10%, all other indexes were up. Sector indexes were up 15 to 20%, with metals under 25%. So if someone just avoided the IT and pharma or had lower exposure, did much better. Yes, the mid-cap index and the small-cap index did a bit worse than expected, but that's okay because 2022 was a year where we had COVID and the war and the rates rise and so on and so forth. But we think that all that is now behind us. Maybe a bit of earning downgrades from a global perspective in US and some in India are pending. But going forward, we look towards all the headwinds that faced us in 2022 kind of settling down. And overall, if you look at, again, the emerging market context, we do think the countries which are where the promise of savings increasing, like fiscal deficit is in control, current account deficit not too high, I think those countries are in a favorable position to get global allocation of capital, and that should mean that the overall outlook should be much better than 2022. Having said that, at the overall market level, I think the returns might still be in high single digits or lower double digits. It will again come down to sector and stock selection and outperforming the market to generate that healthy returns.
You're suggesting the next question yourself. What should be those sectors?
Right. So I think, we have been bullish on the banks, and given the way the rates have gone up and given the credit strong demand that you were still alluding to just before, we remain positive on the larger banks. Even within the financial space, there are ways to play it. For example, the life insurance. I think the valuation is quite attractive, and they are also an indirect beneficiary of higher rates. So I think that is one financial sector that we like. We also like the capital goods sector. In the capital goods sector, of course, we are making a several change vis-a-vis 2022. In 2022, we were also overweight some of the capital goods companies which has global exports to the developed markets. This year, I think we will be more comfortable with buying capital goods companies who are India specific and or Asia emerging market specific.
All right. Hi, Rana. Morning. Rana, I wanted to. All right, yeah. Rana, I wanted to ask you about the earnings number that you put out. That's still a risk, right? Global earnings have not really adjusted, and even in India, we have not seen any big pullback in earnings. We're still working with that elevated earnings projections. Don't you see that as a bit of a risk for equities?
No, of course, I think earnings still have some downside risk. But the thing is that earnings and the PE will not bottom at the same time. In 2022, the PEs have corrected quite a bit, and the earnings did not correct as much because the nominal growth was so high. So the earning correction did not happen, but the PE is already corrected. As you going forward in 2023, you see some bit of earning correction, but we do think the correction will be lower than people feared because nominal growth is still going to be high. You will have some support coming through from the multiples, particularly in the second half of the year when the outlook kind of gets towards that when will Fed start reducing rates. So our view is that by end of this year, you will have the rate reducing cycle beginning. But I think as you know, the stock market discounts few months in advance. So this year we are looking for earning downwards, but less than the markets fear, but some support from multiples overall.
Okay, so coming back to sectors, then you said that life insurance companies, the valuations are looking good to you, and you also like manufacturing, specifically capital goods.
Yeah.
What else attracts you in a market like India?
Sure. The other sector that I was referring to, we have been bullish on the urban consumption last year because of pent-up demand and the valuation of attractive reopening trade was there. I do think they're going to do well, but increasingly what we're looking towards too, that when is the time to buy more diversified, more broad-based India consumption, like a rural India part of consumption. They have not done well, but I think there are some signs that the growth is there, is picking up. So, for example, something like a two-wheeler, which we have avoided for quite a long time, I think something that can be looked into. Consumer staples companies, I think although overall the index level, they have done all right, but I think the valuations are corrected and the expectations are low. So the bar to beat the numbers are not that high. So I think this switch from urban to rural consumption is something that we have to keep watching in this year.
Okay. Now, the classic dilemma, as you pointed out, if at an index level we have to settle for high single digits, the interest rates are, springing up. Even the small savings rates have been increased, and banks are, SBI is giving 7%. So you think that may detract?
Yes, I think some of the capital flows from, let's say, even in India, we spoke about global allocation, but some of the capital flows from the market to fixed deposits and all those things will happen. But I think this year, for making good returns, again, the sector and stocks will be very specific. And we do think the sectors that we like, there we're going to get much better returns than 6 or 7% that's given by the term deposits of different banks. And also we are, we all know this, that the taxation treatments on equities are much more favorable. So overall, total return perspective, I think is still going to be good. Even if I think you look at 2023, I would say that the broader markets, and particular sectors that we mentioned, and let's say the mid cap and some of the small cap stocks there represent much better opportunities.
Okay, Rana, we will let you go on that note. Thanks a lot for stopping by and speaking to CNBC TV18. Appreciate your thoughts. That is Manulife Investment Management. They like a couple of sectors in India. They like life insurance companies. They're looking at the banks as well. Of course, that remains their top favorite. They like urban consumption.